Hi, this is Brent from TradeGuild.blogspot.com, and it is about 1 in the morning on the 8th. We're looking at the market for June 7th. Pretty bad sell off today. Um, the yield on the 10-year note crossing the 5% level today for the first time since August had a lot to do with the sell off. Um, there's a lot of reasons why, but higher interest rates are not good for the market. So, one of the other effects of higher interest rates is the safe haven of treasuries become more appealing as they can garner a higher rate. And another effect on the market is the cost of borrowing money. So we'll take a look at the mid caps today. Mid caps got hit a lot harder than the rest of the market, blue chips, primarily because of the cost of borrowing money. A couple things that contributed to the rise on the 10-year note. And one thing was New Zealand raised their benchmark rate to 8%. There was there was an uptick at least in mortgage-related hedging, and traders pretty much ruled out a rate cut this year, so that is not helping matters at all. And pretty much the nail in the coffin today was PIMCO's Bill Gross late in the day. After 25 years of being a bond market bull, said he is now a bear market manager. Okay, so we're going to take a look at some of Warden's T-series indicators. I'm not, I'm kind of a perma bear, so I'm not going to. I just always assume the market's overbought, so I'm not going to sit here and claim any credit or anything for calling this move. Actually, we've been talking about the market being ready to drop for a while, but so is everybody else. Nothing special there. But I'm going to show you a few indicators really that I think help you as a trader to identify areas like this, or at least be more cautious moving into them. So here's Warden's T2110, which is percentage of stocks trading one channel above their 40-day moving average. So in blue, I'm just using the Qs as a reference for the market in general. I'm not sure if that's the best to use, but we're going to go with it. So anyway, the Qs are in blue, and you have your dates down here: March, April, May, June, and the indicators in white. So this is the percentage of stocks that are trading one standard deviation above their 40-day moving average. And as the market goes up, so should this number, more or less, to reflect strength in the market and breadth. So as we can see here, during April we were pretty much in gear, and then into the beginning of May we started to see some slippage in this. So as the Qs in the market were going up, we started to see the percentage of these stocks go down. So this is a warning indicator. Let's take a look at T2115. This is the percentage of stocks trading two standard deviations below their 200-day moving average. What this more or less is an inverse relationship to the market. When we see a spike in this, it is a pretty good indicator of being oversold. Now, a market can be oversold a lot longer than you can stay in the game. So trying to pick tops and bottoms of moves is a very, very dangerous game to play. But again, this can give us some indication. As you can see in the past, when we had spikes over here, this kicked off a nice move. Spike over here was the end of this correction. So we could go quite a bit higher, or we could see a reversal here soon. So let's take a look at a few more here. Here's T2108. This is percentage of stocks above their 40-day price moving average. Okay. Okay, yeah, we have one channel. Okay, this is just percentage over their average, no standard deviation above. Same thing, same results as the T2110. So you can see there's weakening in the market. The market breadth is not holding up with the advance. Here's T2125, NASDAQ advanced decline line. You can see that it had fallen out of gear as well over here. So lots of warning signals here, and unfortunately we don't have a really good way to pinpoint things such as oversold, overbought, when a divergence is enough to make a change, to make a course correction. Here's one channel or one standard deviation above 200-day moving average, percentage of stocks. Again, you know, all these indicators look almost exactly the same. They're all showing this market becoming more and more thin. It's advancing on fewer and fewer issues, or strength in fewer issues. So those are those indicators. We're going to take a look with the time we have left in this video at some of the ETFs for the market. We're going to start with the Qs. You can pull up the Qs here. And here I have a whole bunch of moving averages. I'm just going to kind of delete these out real quick. And I have some support lines drawn in, so you can pause the video if you want, and you can see where support should or may kick in here. Pretty good support coming up on the Qs here around 46. Then this gap back here in April should provide a little support. Might even see a little bit of support off the gap over here. So we'll see if the Qs can hold up at this level. It'll be interesting. You see a lot of increasing volume there as this move is developed. So I'm not sure, you know, what's going to happen here. There's a couple indications that maybe we're going to get a bounce, and I'm going to show you a couple of those. But first, I want to show you my indicator 3C, and I'm going to show you a 15-minute chart of 3C. And basically, you know, this indicator works just like the other indicators we were looking at. It should advance and make new highs with price. And here you can see, as I zoom out, I probably don't have the very best colors here for this indicator, but you can see as price is making these new highs up here, this indicator's just been way out of whack. You know, suggesting, actually, look what happened last time we had this divergence right in here on this high. We got a real nice sell-off there, a pullback. And we can see, you know, into this high over here. Let me zoom in a little bit so you can get a closer look at that. Into this high over here, you can see we had another negative divergence, totally divergent with this back area. So this move up here, I think, was just destined to fail. There was just absolutely no strength. If you're not using 3C, which many people aren't, because it's kind of my private indicator at this point, you can even look at TSV, which 3C is based off, and you can see the divergence in TSV, and you can just see how it's deteriorated moving under that zero line. So I told you that I saw something that might indicate that we're going to get a bounce here. Maybe it's just an intraday bounce, I don't know. Here's a faster version of 3C. Here's a 3C daily chart. Again, you can see this negative divergence in here. But here's a 5-minute chart, and look what's going on here. This is kind of interesting. We have a positive divergence that developed actually in the last 2 days as price has been moving down. You can see it here as price has been moving down over here. We even got a little bit of a move off of this one here this afternoon, and it's actually made a new high up here, so that's in a leading divergence. I think tomorrow morning we may see a move higher here in the market, probably in the Qs specifically. I don't have a lot of time left in this video, but we're going to take a look real quick at the spiders, which is the ETF for the S&P 500. And I'm going to delete these indicator moving averages again, give you a look. You know, look at the move today, just broke through 2 support levels, almost 2% drop. That's real significant. Next support coming up around 148 here off of this gap back here in April. So we'll see what happens tomorrow. I'm out of time on this video. I'm going to come back with 1 or 2 more, and we'll look at some more stock ideas and a little bit more of the market.